Well, welcome everybody. Good morning, good afternoon, good evening, wherever you are in the world, to this webinar on innovations in flood insurance in times of climate change. This webinar is hosted by the Risk Management and Decision Process Center of Wharton, the Grantham Research Institute on Climate Change and the Environment, the London School of Economics, and the Lloyds Tercentenary Research Foundation, of which I'm the chair. My name's Andrew Carrier, but perhaps the University of Pennsylvania and the LSE need no introduction. Perhaps for those of you that are not familiar with the Lloyds Tercentenary Research Foundation, perhaps I can just give you a little bit of background on what we do. We exist to fund research into the field of risk for societal benefit, and we're always keen to hear from any early career academics with any interest in researching particularly the protection gap, that is the gap between insured losses and uninsured losses. And that's one of the things we'll be talking about today in terms of flood insurance. And I must admit, it's very topical, our subject for today's webinar, particularly in view of some of the events, some of the unfortunate events which are taking place in Europe, particularly parts of Belgium, Germany, and elsewhere. So I think it'll be very interesting to hear from our speakers today regarding flood insurance and some of the innovations around it. So I'm very pleased to introduce our three speakers. We're very lucky today to be hearing from Carolyn Kousky, who is an executive director with the Wharton Risk Management and Decision Processes Center. We'll be hearing also from Swenja Surminski, who's deputy director and head of adaptation research at the Grantham Research Institute at LSE, and also from Craig Tillman, who's president of the Risk Sciences division of Renaissance Re, a very large reinsurance player in the global financial reinsurance market. So very happy to be hearing from Craig, Swenja, and Carolyn. And so I think without any further ado, if the technology is smooth enough, I will be handing over to our first speaker, who I believe will be Craig.
Thank you, Andrew, and I hope that everyone can see my slide deck, the first slide anyway. It is certainly a pleasure to be here today and address this group about flood insurance in times of climate change. And in particular, I wanted to talk a little bit, at least on a preliminary basis, about escalating risk, protection gaps, and the role of reinsurance. The big picture, I think, is that the impacts of extreme events are coming faster. They're hitting harder than ever before. And at least one critical driver is climate change. Risk can be expected to escalate for most atmospheric perils as climate change, demographic shifts, and inadequate physical resilience are all sort of coming together to drive the extreme risk that we face to levels that are much more challenging than we ever faced before. The slide lists at a very high level how climate change is impacting many worldwide perils. Notice that a lot of these perils are growing more volatile as the overall hydroclimatic intensity ramps up. That's essentially the result of climate change increasing the incidence of precipitation extremes, both on the low end with drought and on the high end with outsized rainfalls. A lot of physical reasons for this I won't go into, but among the important effects on this list, severe flooding, severe inland flooding will become more frequent. Precipitation related to tropical cyclones will be intensified. Sea level rise in combination with much more intense hurricane winds will increase surge-related flooding, and severe droughts will become more likely and more intense. It's clear that we're already seeing the edge effects of these impacts, as Andrew noted. This is rather a topical discussion for the recent floods in Europe. But there are other events that we're seeing pretty much on a weekly basis that really seem to have the fingerprints of climate change on them, or at the very least represent important harbingers of our future as climate change continues to ramp up its influence. This is especially clear when we look at that regional flood risk, which is further exacerbated by drivers like urbanization and a built environment that's highly vulnerable to flood hazards. In many ways, we're sort of at this turning point. We're seeing a shift in how we need to understand many perils. And I think we need to be more inclusive in our understanding overall. This is about climate change. It's about systemic risk. It's about densification of exposure to urbanization, all coming to challenge our understanding of natural hazards risk. At a minimum, we need to understand the variability of the last 10 years and the next 50 years doesn't look anything like what we got used to over the last 100 years. So this is a new regime. Now more than ever, we need to sort of encourage a view of hazards and an understanding of effective adaptation and an open communication of risk that at its core is transparent, objective, and action-focused. Things are moving quick. We need to take quick action. Our industry, I think in many ways, is situated to be a catalyst for these initiatives. We have the experience and we have the tools to quantify impacts. So making this more widely, this sort of tool set and this experience set more widely available to government, development institutions, sovereigns, and other stakeholders, that's, I think, a key avenue to getting ahead of the curve in a very fast changing risk landscape. It recognizes that the solutions needed are integrative in nature across both public and private sectors, across the individual and the community, and across the developed and the developing world. The regime change, I think, also threatens any progress towards lowering the overall protection gap that we continue to face. We have sustained this for some time now with natural catastrophes. That gap has really widened across time. Here's a view of that gap since 1990. While the 10-year average for insured losses continues to grow, however modestly, it's substantially outpaced by the growth in uninsured losses from natural catastrophes. And this is not just a problem in the developing world. This is also a problem of the developed world, where many regions are continuing to experience large shortfalls in protection. And probably most interesting, I think, these shortfalls continued in a time of expanded access to inexpensive and willing risk capital. Yet when it comes to natural catastrophes, many of those at risk are ignoring or at least rationalizing away the very disruptive effects of extreme events. So my personal fear is that climate change continues to widen this gap. Hopefully we can prevent that. Now, of course, growing protection gap actually magnifies the economic impacts of natural catastrophes. This is seen by many homeowners, businesses, and most dramatically by communities and whole economies. Without quick, unencumbered access to capital for recovery and repair, those entities are set on a path of weakened prospects, often very long-lived. At a country level, those impacts can last a decade or more. So it's not only about the destruction of economic capital, but it's also the destruction of human opportunity in many regions of the world. So with greater protection, we have nearly the opposite case. In fact, if you look at the graphic here, it actually argues that the high levels of protection can actually offer more than just resilience. They offer growth prospects that go beyond the previous baseline. And that makes sense. As capital flows in after a catastrophe, a large economic opportunity is suddenly realized by the affected region and actually by periphery regions. So that opportunity grows the job base, it drives up business engagement, and overall it's providing a better footing that actually could be used to achieve even greater resilience from the next natural catastrophe. We always know there's a next natural catastrophe awaiting us. So our industry, I think, can be a force for very positive outcomes, but that will only be the case if we rise to the challenges that escalating risks bring to our businesses. So if you widen our view and actually think about what the role of reinsurance is in our challenging world, I think it's fair to boil it down to two statements here, the mission and vision statements of the reinsurance model. Attracting returns on invested capital over time, bringing those returns and ensuring that longevity of our business, that's an important mission. But at the same time, the vision has to be about improving resiliency and the sustainability of people, businesses, and economies in response to loss. That role, I think, is becoming more essential in a world that's dealing now with the complexities of climate change. And specific to the mission of creating attractive returns, you need to grow the pool of addressable risk. That's why we were trying to attack that protection gap problem. We need to continue to enhance risk understanding. You see a lot of investment in that regard by insurance and reinsurance entities. And we need to embrace technology for not only operational efficiency, but also technologies to help us understand risk better. And finally, I think we need to replace rigidity with flexibility. That's a hard one for the insurance industry, admittedly, but that's where we need to go. On the vision side, we need to close that protection gap. We need to increase resiliency through mitigation. We need to embrace the digitization of our supply chains and think about how changing consumer behaviors can be embraced so that we can encourage more insurance culture. And finally, we need to embrace the changing risk landscape. We need to underwrite innovation that addresses that. So I think a lot of this boils down to this sort of final slide, which I think hopefully is a blueprint for what we need to do collectively to create value in the face of this fast changing landscape. It's really about supporting partnerships for mitigating risk and increasing resilience to disaster in communities on a worldwide basis. First, it's about sharing knowledge and risk quantification expertise. We've got a lot of that. Second, it's about providing real world experience and knowledge about that we have the most effective measures for the prevention of loss. So really studying preventive measures, whether it be mitigation or other measures, so that we can actually avoid or at least lower loss. I think that our industry is doing a pretty good job in supporting that type of research, but I think we need to do a better job in communicating it. Third, I think it's about creating platforms that encourage innovation. And that's often, I think, about getting out of this traditional mindset about risk transfer and finding other ways to accomplish risk transfer. And finally, I think it's really getting closer to the client and really understanding what their true risk transfer needs are, offering solutions that have their mindset involved. And so we're actually getting to challenges more directly, essentially helping them understand and transfer their risk much more effectively in the process. So I'll stop there, Andrew, but thanks again for the opportunity.
Thanks, Craig. That was a fascinating and extremely rich and dense and succinct summary of our subject today, particularly from a commercial angle. I think we'll do some Q&A right at the end. So if I could take us straight into Swenja's presentation next, if that's coming up. Here we are. The floor is yours, Swenja.
Yeah, thank you very much, Andrew, for the introduction, and welcome to everybody also on behalf of the Grantham Research Institute. It's a real pleasure to co-host this. I'm also a trustee of the Lloyds Tercentenary Research Foundation, so very nice to connect some dots, and I like working with Caroline. So it's really good to see these sort of three players coming together here. Yeah, so I want to leave you with a few, bit of food for thought on flood insurance, because that's one of my focus areas in terms of research, but I also used to work in the insurance industry. But I didn't want to start without putting this a little bit into the context of recent events. And, I don't think you need to be reminded, but, we've all seen the very shocking pictures that came out of Germany, Belgium, Netherlands, and also just recently from China. And, that's just on the flooding side. We've obviously seen a lot of other sort of climate-related hazards occurring and threatening people and property basically around the world. So, well, in fact, my flooded basement that you can see there in the top, which happened last week in London here, pales insignificant, but I just wanted to show it also as an illustration. I mean, this affects, this can affect all of us basically. So, but I think what's really important, and I liked, Craig, you referred to this a lot when you talked about resilience, is I think this underpinning imbalance that, our society remains inherently reactive. And we've looked into this in terms of how funding, disaster risk management funding is allocated. And a very small proportion of that is actually going into what I call prevention and risk reduction. And a lot goes sort of into after the event response, repair and reconstruction. And I think in economic terms, in humanitarian terms, that is very inefficient. In the context of climate change, it is almost reckless because we are kind of making our lives extremely hard. And yeah, sort of that's for me the sort of core message here, what insurance can do to actually address that imbalance. So yeah, some guiding principles I wanted to share. And then I just want to leave you with a few examples of innovation in the space of flood insurance. So the key starting point is, when we talk about flood insurance, we need to see it as part of an integrated approach. We really, because of the scale of the issue, the scale of the risk, we need to basically use all the tools that we have in the toolbox. And this is sort of one way of describing all the tools here. I don't want to go into detail, but you see there is a whole range of things that can be done to help us manage risk. And insurance plays a role in that, and you see it there in that box, but it's not a silver bullet, and it can't actually deal with risks on its own. So really important point to remember. But then also, what is the role that insurance can play in this? And I think this is where, the discourse has evolved. And I like to look at it at sort of through two lenses, and we call this like the preventative and the curative role. So, there's a dimension of prevention and using it to also encourage us more to be more anticipative and reduce risk wherever possible. And then there's the curative aspect, if the damage has occurred, to then sort of take care of the risk and then put us back into the same position or in a hopefully more resilient position. Well, our research shows that, the existing mechanisms are actually not very good with the preventative aspect. And I think that's going to be the key challenge to sort of address. And that's where I think innovation needs to focus on. But our work with industry, and here you see some examples from the Geneva Association, sort of thinks this through a more holistic way. And I think some of that resonates to what Craig outlined there, the different roles that insurance can play and what it can actually bring to the table. And, I think this is a really important aspect, but, it's a nice concept. The reality often looks very different. And we've done research, Caroline was involved in this, comparing different systems, the US, Germany, the UK, Canada, and Australia. And you see there are pockets of that sort of interaction, but I think there's a significant opportunity to really improve this and beef this up and actually have more effective collaboration there. But I think what I often say to my students is, the key to closing, well, I don't call it the protection gap, I call it the resilience gap. So I think the key to closing that is to actually involve all those different actors. And this is a sort of fairly stylized decision chain where you see sort of from the moment that in this case somebody decides to build, let's say, a block of flats, all the way to the end when someone then takes out insurance. And all these actors make decisions that will determine how, where something is being built. In that usual chain, insurance comes all at the end. insurance has a lot of knowledge, a lot of information that should actually help to inform the prior decisions, but in reality, it often doesn't. And, you know, this is just an example. And I think it sort of highlights where I think there are opportunities to actually bring insurance and its skills and knowledge to the table. But then the reality, looks slightly different. I mean, we're doing a lot of research here at the LSE around flood risk in the UK, and we worked on the flood pool that was set out a couple of years ago to deal with flood insurance in the UK. And you know, it's an interesting approach, and it is an example of innovation. But the problem there is the way it's designed is not really sort of designed sort of consideration of changing risk, and not considering the preventative role. And here you see actually, you know, the highly subsidized price that that Flood Re offers is great for people currently at risk, but it raises a lot of questions because the green bars are basically the technical risk price that are already significantly above that subsidized price. So how do we deal with that as a society, and how can we actually use systems such as Flood Re to sort of change the equation and make sure that actually these future risk considerations are currently considered? And at the same time, it raises also fairness questions. I mean, we looked at different ways of communities in high risk areas and their access to insurance at the moment, and their ability to buy insurance. And I think this is something that Caroline's work will also pick up. So this idea that, you know, we need to avoid creating flood risk ghettos because it's cheap to live there at the moment, and then it becomes sort of a really sort of high risk area without insurance and without resilience measures. So I said I would give you a few innovation examples, and keep in mind my perspective kind of comes from this resilience risk reduction angle. And here's an example of what we're doing as part of the Flood Resilience Alliance, which actually has insurance almost at the end of its considerations. It focuses on understanding community resilience, and it develops sort of a very holistic approach to actually give communities across the world in developing countries, but also in the UK and Germany, the tools to understand resilience. And on the back of that, then also identify where insurance could help, could play a role. And I think this is an important perspective because it really focuses on resilience rather than on insurance. Another example is something that sort of looks specifically on longer term changes, coastal change and flooding and coastal erosion. Marsh, the insurance broker, is involved in this and is currently looking at innovations in terms of risk transfer solutions for this type of risk, where we know certain coastal areas are at risk of erosion, and it's more a question of when rather than if. So how can you design insurance related ways of managing these costs here? And I'm just sort of listing a couple of examples there. Then the third example I just wanted to mention is Bangladesh and parametric flood insurance. And when you hear Bangladesh, it's probably one of the most flood prone countries in the world. And you know, you would think, well, you know, what can insurance do in that context? But the challenge here is to really sort of look at the needs. In this case, it's the needs of local authorities that actually are tasked to deliver flood relief and deal with floods. And what can we do to sort of use insurance to help with that, and at the same time create also a platform for a more efficient distribution, and then making sure that the money actually goes also into resilience building. So, you know, there are lots of details in here, but I just want to mention this. It's a project we're involved in with Vivid Economics. And then the last example, I've alluded to that, is Flood Re here in the UK. And yes, it is an innovation in itself, but, and you know, it's no secret, I often said that I think it's also a missed opportunity because it doesn't really contain this prevention element. And currently there are lots of efforts, and Flood Re is kind of working on this in terms of what are the levers, how could it actually be adjusted and changed and reformed. And you see here a couple of sort of ideas that are floating around, and it's a very sort of live discussion. And then just at the end, to leave you with a couple of thoughts, because we're focusing today on flood insurance, but obviously a lot of the things that we're discussing here relate to this wider question of, what is sustainable insurance and what role does insurance play in the climate context. So 5 sort of takeaways where I think, there are already efforts underway, but usually it's the industry leaders. And I think the key is, to take the rest of the industry along, and also point out that this is not just a question of, CSR and being, seen as responsible citizens. This is about business viability and creating sort of a renewed insurance business model, I would argue. So I'm happy to discuss this, and yeah, thanks again, and looking forward to the discussion.
Thanks, Swenja. That was, again, a very, very rich presentation. And it certainly brings it home to see you up to your ankles in the lower ground floor of your London apartment. I also was in that very heavy downpour in the UK last week, but it certainly brings it home that the issue we're talking about today touches each and every one of us. So now I think we move on to our third presentation, which I see is getting lined up. And now we will hear from Carolyn.
Great, thank you so much, Andrew. It's wonderful to be here with all of you today. I'm going to talk in my few minutes about some work we're doing with the support of the Foundation on improving the financial resilience of lower income households, particularly in light of these escalating extremes like flooding. Part of this has been looking at inclusive insurance models, specifically parametric microinsurance, and what role that could play in the US and other developed countries where it hasn't really been used to date. So I'm going to focus in on sort of innovations in one narrow slice of the problem, kind of zooming in from Craig and Swenja's larger remarks. So we know that there's sort of a very robust body of research now that low-income families and communities suffer disproportionately from disasters. And there's many aspects to this, including being more likely to live in riskier areas and less safe construction, having less access to information and educational materials about risk, and so on. And in this project, we've been primarily focused, though, on the recovery piece. And when it comes to financial recovery from a severe flood, there's essentially 4 sources of funding that households can turn to: their own savings, they can take out loans, they can have aid from government, friends and family, NGOs, or insurance. But we know that low-income households struggle with access to all of these sources of funding after a disaster. They don't have enough savings in the bank. We know that a really bad flood in the US at least can cause thousands, tens of thousands, even sometimes hundreds of thousands of dollars in damage, and families just simply don't have that kind of cash sitting around to make those kind of repairs. While loans and credit is often the first line of response in the US after a disaster, low-income families often can't take on more debt, or they're actually locked out of those loans altogether. So we have work at the center showing that as income declines, disaster loan denials increase because they don't meet those basic financial metrics, right? So while loans might be a useful post-disaster strategy for higher income groups, they're not a good response for low-income families. And then we also know our government programs, we could do a whole thing on this in and of itself, but are insufficient. There's not always federal aid after a big disaster event. And this is increasingly true for the sort of growing intense precipitation events that are impacting, places all over the globe, but often those cause very localized flood damages in, say, one part of a city, and those never rise to the level of getting federal resources in the US. When federal aid is available, it's often too delayed. We're talking months or years, and sometimes just really too small. And none of our federal aid programs are really means tested. And there's recent work suggesting that they tend to go to wider and more privileged areas when they're made available. And then we also know, while you could, maybe turn to friends and family to help you, if your friends and family live near you, they're all going to be impacted by the disaster too. So that really leaves insurance as being so important. And yet, for low-income families, disaster insurance, flood insurance is often unaffordable. But the constraints on having these post-disaster financing has spillover effects for all aspects of life. And there's now several papers from countries around the world that have documented that having the resources be able to rebuild and repair and get back into safe homes has been linked to emotional well-being, mental health, physical health, education, educational attainment, and the stability of families. And that's because without financial resources to recover, households have to turn to coping mechanisms that have really long-term impacts. Again, these research studies are global in scope. You might divert expenditures away from other important things, or it really limits your ability to build wealth. So we have this really big problem, that was all to say, right, about how we help these households and communities recover from disasters. And while, I think there's a very important role for the public sector here in terms of direct aid to these households, we've been looking at sort of what the private sector or private public sector working together can do through risk transfer. So specifically, we've been looking at parametric microinsurance. I'm sure, sorry about that. Most listeners are familiar with the concept of microinsurance. It's been used now for years around the globe for a variety of types of coverages, things like health, life, crop, livestock. It's been used mostly in developing countries until this past summer. This model had not been used anywhere in the United States. And so we've been looking at whether there's an opportunity here to sort of take this model and adapt it and address some of these needs here in the US. And I think it kind of has spillover lessons for other developed countries. So to make the economics of microinsurance work, they're almost always parametric products. Again, I'm sure most listeners are quite familiar with the idea of parametric insurance. For those of you that aren't, most insurance in the US at least is indemnity based, right? You have to get a payout related to the amount of damages that you sustained, but there's really high costs associated with that, and it's time consuming and often contentious. You have to have someone come and assess all your damage. So parametric can be a lot faster, the dollars can be used more flexibly, but important for our context, since we sort of eliminate some of the time and the cost with loss adjusting, it can make the economics work better when otherwise lower limit policies, there wouldn't be enough premium revenue to cover expenses. Okay, so we've been taking this model that's been used, like I said, in many places around the world and thinking about applying it here. And there's really 4 big challenges with this. So first, since the target population of microinsurance is lower income households, it's absolutely necessary to keep the premiums as low as possible, right? To have a product they can afford to purchase. But this makes it, as we've been talking about, much harder to find a potentially profitable and sustainable business model. And so frequently what we've seen in other countries is that microinsurance has been supported by the public sector or with philanthropic dollars, since profitability can be a challenge, but also because microinsurance has the ability to unite insurance with clear social objectives in terms of poverty alleviation. And so it might be support for just the upfront cost of setting up a program, it might be sort of through a public sector program, or it might be ongoing premium support. Okay, second, unlike some other countries where microinsurance has been adopted, the US, right, has a highly developed and regulated insurance market. And so parametric microinsurance has to fit within that existing regulatory structure. And I'll show you next some information from Puerto Rico, which is the only US state or territory to have actually developed regulations explicitly for microinsurance, and a couple of the issues that come up in trying to do that. Third, in practice, microinsurance is really not designed to fully indemnify all losses. It's designed to jumpstart recovery, to assist with filling gaps in assistance. And as such, total losses, are typically going to exceed the payout of a microinsurance policy. But that said, a concern we heard, especially with regulators, is that the product, sort of a microinsurance product, failing to provide a payout when the consumer expected it would. So as opposed to the gap between the payout and the total losses, but the gap between the payout and what you expected the payout to be could really leave households more vulnerable if they don't take the appropriate risk management options to manage that. Third, we know that there are, we're at the end here, the ongoing challenges with voluntary demand for disaster insurance at any income level. And, we've already talked a lot about trying to close the insurance gap, and lack of demand is one issue here that comes up again in this area as well. And often we've seen solutions to this by coupling insurance to other necessary products. So in a sense, force placing it on customers, or, actually buying it on behalf of those at risk. Okay, so just a couple more slides. I wanted to quickly say something about what's happened in Puerto Rico and then wrap up. Last summer, Puerto Rico finalized regulations around microinsurance. And so to be called a microinsurance product, the policy has to meet certain criteria laid out in these regulations. I think the 2 things I wanted to call attention to was, first, one challenge with parametrics across the board in the US, and when you're sort of targeting the household market, is proof of loss requirements, right? Because insurance has to be indemnifying against some loss. But interestingly, in Puerto Rico, the insurance commissioner completely waived proof of loss requirements. And the challenge with something like parametric microinsurance is that the proof of loss requirements could be so time consuming or costly that it would basically undermine the model in the first place. But so by completely waiving them, they freed them up of that. And they essentially made the argument that if a severe hurricane or earthquake is going to hit Puerto Rico, the damages to a household are going to be such that any microinsurance policy is going to never be a financial windfall. It's never, so it's never going to kind of be more than people need to get back on their feet. And so they felt comfortable waiving that. The other thing I wanted to highlight is that the law created new roles that didn't exist before: a microinsurance administrator, solicitor, and distributor. And I think this last piece on the distributor is important because when it comes to microinsurance to really scale, it might be distributed through completely different channels than traditional US property insurance, which would rely on licensed agents. It might be sold attached to other products and so forth and so on, right? So we're going to have to think about that in the context of the US. Okay, and then just to wrap up, we've looked at some different possible models, adapting what's been done in other places around the world for what might work here. One that we're working on actually with some partners in New York City is sort of like an aggregator model where you have a NGO or a city agency purchasing the insurance on behalf of the low-income families that are at risk and managing the insurance payouts and claims. We've also been looking at mobile models, which we know have been pretty successful in lots of other countries. And here in the US, it's also the case that over 70% of those making less than $30,000 a year still have a smartphone, which really opens up the mobile platforms. We've also looked at public sector programs. Can our NFIP, our federal flood insurance program, offer a micro insurance product targeted at some of the lower income households who we know can't afford the standard NFIP policy? We've been looking at municipal captives and whether they could offer a program. And then finally, this idea, which I mentioned before, of coupling it to something like your lease or your credit card or your utility bill, or maybe even coupling it to existing government programs. So we have a program in the US that provides assistance to low income households with the cost of energy. Could that also provide something like disaster microinsurance, flood insurance for households? So these are some of the things we're thinking through. So that's all I have. I just want to end by saying, I think getting some of the innovative ideas like this off the ground, like some that Swenja mentioned and so on, right? The whole idea is that these are going to be even more important as climate changes and as we see these climate impacts coming so quickly and so furiously at us. Okay, thank you so much.
Thank you, Carolyn. That again was a fascinating and immensely rich presentation. I don't know about the other attendees, but I'm feeling slightly punch drunk. We in just over half an hour, I feel like we've had many hours worth of material here so much to take in. So. I think just while we gather our thoughts, if I could ask the attendees if anyone does have any questions for our panelists, they could type them into going through the Q&A icon at the bottom of the screen. And I will do my best to pick them up if my screen's not too crowded and field a few questions to the panelists. But just while we wait to see if there are any questions, I wonder if I could ask the panelists the thing that occurs to me, which is, again, the recent floods that we've had here in Europe. They seem so topical, so real, so relevant. Is there anything? I guess my question is there anything that we could have been aware of? Is there anything that we could have learned? Is this a warning of more serious floods to come? I mean, I'm guessing that any reaction from our panelists of what's occurred here recently in Germany, in Europe, and perhaps Swenja, could I ask you to kick off?
Yeah, thank you. And yeah, it's been really shocking. I mean, I think particularly the significant loss of life, which I think, a lot of people wouldn't expect that from, sort of Western Europe, where, we're used to different kinds of floods, I think, and that's an important message. So there are lots of lessons to be learned. And, I think it is early days to also say, you know, what all the contributing factors were. But I mean, there are a couple of things that are quite clear. I mean, yes, this fits in with the climate change picture. I think this particular localized heavy rainfall, which kind of exhausts basically all the systems that we have in place. And I think particularly is also this notion of people either, you know, are aware of river flooding, which is usually at a very different pace. You have much more advanced warning, you kind of gather your things, you move them away, you have more options. But what happened there was, you know, the time between, you know, the rainfall and the flood, I mean, it was just extremely speedy. And I think this is a new notion that I think we need to get used to, and we need to revisit how then forecast and early warning is passed on to people. And I think particularly this question of, you know, evacuation and protecting vulnerables in care homes and so on. I think that raises important question. I think questions for insurance will also come, but I think at the moment, the main lesson is, you know, what can we, you know, do to protect lives, because that was really shocking, I think.
Thank you. Can I just ask Craig, Carolyn, any observations from yourselves?
You know, I actually absolutely agree with the, you know, there's certainly a life safety issue that's really, this event really highlights that. You know, could the area have been more well prepared for flood? Possibly, but I don't know that this is something that points to an engineering solution. This was a precipitation bomb, at least by all reports that I see. So the economic realities of preparing for something like that are pretty awesome. And I think that we do have to think about how we create warning systems that can enable us to at least address the life safety issue. I think the rainfall amounts in some places exceeded previous records by more than 50%. And to me, it's sort of a marker in the sense that we should be thinking about how well our simulation models are keeping up with the pace of climate change. In fact, you know, internally, we like to think of climate change ramps for each peril that we think about on a region peril basis. And I think that this shows us that we can't only depend on simulation models. We also have to ask ourselves what's plausible. So outside of the simulation game, so to speak, but more what is actually plausible in this region peril combination, and how should that inform the results that are coming from our simulation models? Because in some cases, climate change is going to be realized in extreme events quicker than we can anticipate, than what our simulation models can anticipate. So I think we need to be ready to almost have a very inclusive approach to understanding what's possible.
Thanks, Craig.
I was just going to quickly add on to kind of build on what Craig said and echo the point that I think one of the biggest challenges for flood risk management in the coming years are exactly these kind of intense precipitation events and the sort of intensification of the hydraulic cycle that Craig mentioned, whether it's, you know, Swenja's basement or what we saw in Germany, because often too, these types of precipitation events are not the type of flooding that communities have been preparing for. You know, as Swenja mentioned, you know, river flooding, or, you know, we deal with a lot of coastal flooding along the South and East US. It has a very different profile. And we've been telling people they're at risk, and we've been thinking about risk management strategies for very specific geographic regions. And these intense precipitation events are happening outside those geographic regions in totally different areas. And people just really, you know, as Craig was saying, are I think unprepared for what's going to be coming at them.
Thanks, Carolyn. We are getting quite a few questions in, probably more than we'll have time to deal with. So inevitably, my eye is probably going to the shorter phrased questions. So I'm just staying with you, Carolyn. I think here's one from William. How to deal with the lower value perception of insurance products, mainly in developing countries, and how do we increase the number of people disposed to buying this kind of coverage? I suppose it's the question of, you explained the mechanics, but how do we get people to to feel they can buy the product. Carolyn, any views on that question?
Yeah, I think this is a really tough one. We find, so first of all, people don't like to buy insurance of any kind, right? I mean, because we don't like to buy products that don't give us immediate value right away. It's not as fun as going out and buying something for yourself. And we also don't like to think about bad things happening when it's sunny outside. So getting folks to buy flood insurance across the income distribution and across countries has always been hard. And that's why in lots of places it's mandated or it's rolled into another, your homeowner's policy. Some countries do it that way so that you get the coverage without people having to selectively opt in. Because if you have to opt in house by house, it's just a really uphill battle. I think if you're trying to play that game, which you have to sometimes, there's also so many different things that could be going on. So people, there's simply an ability to pay question. They might not have the money at all to devote to it. And then there's really a public policy question in my mind of how you provide assistance to those families. Beyond that, right, there's issues of, do they understand they're at risk? We were just talking about this with precipitation events. There's lots of people at risk who aren't even thinking about flooding right now. Do they understand the risk and the possible damages? Do they understand the financial consequences should a flood happen? And then do they understand insurance, which is kind of a tricky product? And we know that general financial literacy can be quite low anyway, and insurance literacy is even worse. And so I don't really have a good answer except to say that it's really hard. Maybe Swenja or Craig have some more optimistic thoughts on what we do about that.
Well, I'll offer, I couldn't agree more with Carolyn. This is probably the biggest problem we have. First, communicating about risk, and then second, even more difficult is getting people to actually do something about something that's very abstract to them, especially extreme risks. And I think one way to think about it, especially for countries where there isn't an insurance culture, if you will, is depending on government-sponsored parametric solutions that the industry supports, allows the government to be there as a as a stopgap measure for especially the most people that are most at risk for disruption in their lives due to natural disasters. But use that as a technique to grow that insurance culture. So, possibly get people to put a little skin in the game as you go along through some type of government nudging. But I don't think you can just turn a switch and automatically have sort of an insurance culture. Even in developed countries, as Carolyn knows, we still have big problems in terms of people existing with significant protection gaps and ignoring it.
Thanks, Craig. Maybe Swenja, if I could ask you, there's a question directed to Swenja. It says on your 12% versus 88% figure, is it necessarily uneconomical to spend more on disaster recovery than prevention? For example, it could cost many times more to fully protect a flood-prone area rather than react to the few areas where the floods actually occur. So this is a question about prevention versus recovery. Swenja, any views?
Yeah, I mean, the first point I would say is, I think what we're arguing here is that we need to rebalance it. I'm not saying flip it completely around, because I agree that would not be economical. But I think what really needs to be understood is that in prevention has a significant cost-benefit ratio. I mean, there have been lots of studies, from $1 invested in prevention, you save $10 in recovery. And, there are different types of sort of interventions that you can do. They have different sort of payback ratios, but by and large, this is an investment. I think there's a challenge because often it's seen as a cost with an uncertain outcome because you just don't know when the next disaster will be. And I think that's why we are arguing not only to see, resilience through the lens of avoided losses, but also to see it as an investment into, sort of community longevity. I mean, this can open up lots of co-benefits. It can open up, some economic development advantages. So it's really sort of changing the mindset away from just avoiding or reducing the losses. And I think that's where, this imbalance needs to be adjusted. But, I'm not arguing to completely flip it around, but the imbalance needs to be adjusted.
Thanks. The next question, I guess, it relates to different geographic or political perceptions of flood insurance. And the question is, how does one balance partisan in many nations, their budgetary constraints with regard to various critical events at the same time? For example, pandemics or cyber or other natural disasters. So I guess the question is, how does one work with local governments or different geographies to get flood recognized as the risk that it represents relative to other risks that we face every day, such as pandemics and cyber and so forth? Carolyn, could I put that one to you?
Sure, I think it's a tough issue, and I would maybe come back to something that I think Craig was mentioning earlier, about trying to find strategies that are more comprehensive. And so this doesn't really get at the question of sort of local government attention, but I think one difficulty here in the US has been that we treat catastrophes peril by peril by peril, which makes it really tricky when it comes to, well, insurance or risk reduction, both sides of the kind of risk management coin. So, customers here have to have their homeowners insurance policy, then they have to add on flood. They might have limitations on their wind if they're in a hurricane area and have to go to a state pool instead. Earthquakes not included if they're somewhere, we're seeing stress in the wildfire market. And when you're carving up all these perils, it can leave people confused and exposed. And so I think it would be challenging here to kind of give in path dependency, but I think some of the approaches in other countries that have instead required that all perils be in one policy can be much more effective at making sure that everyone has financial resilience across perils, and kind of directing government attention to helping insurers with that kind of tail of the distribution.
Yeah, if I just could add to that, I mean, some cities, we've seen interesting developments there with the establishment of resilience officers, which basically, their perspective, their remit is not just one type of risk, one peril or so, but, they have in mind, the city, the ambition of the city, the sort of different types of population. And then they look through the risk lens, but also try and integrate that and say, okay, well, how does this fit into our vision? Where does our city want to be in 20, 30 years? And if you're a coastal city, how can we make sure our vision fits in with coastal change? And how does it fit in with population change and socioeconomic change? I think that's a very interesting approach there. But of course, it's a struggle because local governments are usually significantly underfunded and over-challenged. So, but it's an interesting avenue.
Yeah, I would add to that, certainly, when you have multiple perils in your mindset, that does lend itself to better decisions about allocating correctly per the risk that you're facing or the risk that you're facing. And I think there's a lot of good quantification tools available. I think another part of this is getting everyone involved, recognizing that you have to find a way to reconcile everyone's different investment horizon. The homeowner has a certain investment horizon for resiliency investments. Government has maybe a longer investment horizon. Banks have a different investment horizon. You actually have to reconcile all those different investment horizons so that you have the right mix of effort that's sort of aligned. So if you can align those investment horizons, I think you have a higher likelihood that number one, you'll focus on the perils that need to be addressed because they are so important to that community, but also that you start to make investments that are rather strategic and you focus on where the highest benefit cost ratios could be realized.
Thanks, Craig. I'm going to try and summarize a number of the remaining questions which talk about the collaboration between government and particularly the insurance industry And I guess implicit in some of these questions I'm reading is, is it realistic to expect that? And I guess maybe I could start by asking you, Craig. I mean, in your presentation, you talked about the modeling capability, but as we all know, some of the modeling companies, for them that's proprietary information which they're probably not willing to share. And so is it realistic to anticipate a collaboration with the commercial world and local and governments?
I think it is. I mean, I think we're seeing it in some places where we're seeing this sharing of knowledge between the industry and governments. New Zealand is one area that comes to mind where there's a lot of sharing and a lot of research supported by the New Zealand government into earthquake risk, but also industry is coming to the table in a big way, helping that government understand better. So
okay, so Craig is optimistic. Carolyn, Swenja, do you share that optimism?
I'm not sure how optimistic I am, but I think it's necessary. And I think there's maybe a path forward, as Craig was saying, in recognizing too that there are some goals that are really common across sectors and that they can be mutually beneficial if we focus on them. So for example, thinking about more aggressive investments in climate adaptation and risk reduction are going to improve insurability. They're going to improve, the fiscal health of the communities that are being impacted. And that has to be driven by a really good assessment of where the risks are. And so it might not be competitive to have the private sector providing a lot of those services if they can be sort of meeting everyone's shared goals and visions.
That's
great. Swenja, I'm going to give you the last word.
Wow, that's great. Thank you. Lots of responsibility there. No, I mean, I agree. And I think we have seen huge innovation being driven by what the private sector can do in this space, and also huge inefficiency by what the public sector is doing or not doing. So I think that in itself calls the problem is so big, let's combine it and let's make this work jointly. But I guess the key challenge there is, in my experience, and I've been working on this from different angles in the industry and also now as a researcher and also advising governments, there is such a big gap in understanding of, different drivers, different, underpinning needs of, I mean, hardly anybody in government understands really insurance. That's an important point. There's a lot of misunderstandings, I guess. And then it's also from the industry, I guess, sort of explaining also the limitations of insurance and making sure that this capacity building element does not get, completely disregarded. I've seen so many pilots where insurance has been sort of thrown at a country or community, and there have been a few workshops and that's it. And people just had no clue what it is. And, they kind of do that once, maybe twice, and then if they don't understand it, they will never ever touch an insurance product again. So, just to highlight a couple of the challenges, but yeah, I think it is absolutely essential to get that sorted.
Okay, so notwithstanding governments perhaps not understanding the insurance industry, I do detect a latent optimism and certainly acknowledgement of the necessity of this need for industry and government to collaborate. So I think, just conscious of time, I think all that remains is for me on behalf of the Lloyds Tercentenary Research Foundation and also Wharton and the LSE to say thank you to our three speakers today, Carolyn, Swenja and Craig. And thank you for everyone who's attended this this webinar. It's been, I hope you agree with me, it's been a fascinating discussion and a super way to spend an hour. And with that, we can adjourn. Thank you, everybody.
Thank you.